All right, let's jump right in. Today, we saw a huge tech sell-off that really shook the market, and it was all driven by one big fear. Is the AI boom a bubble that's finally about to pop? In this briefing, we're going to break down exactly what went down, why it happened, and most importantly, the critical signals you need to be watching for. So let's get to it.
Yeah, the tech-heavy NASDAQ absolutely took a nosedive today, and you can bet the shockwaves were felt across the entire market. So the big question is, what exactly triggered this panic? Well, let's dive into the numbers first to see the full scope of the damage.
All right, first up, let's get a quick overview of the market. And as you can see, it was pretty much a sea of red across all the major indices.
Leading the pack, the NASDAQ got hit the hardest, plunging a really steep 2.04%. This was a classic flight to safety move. You know, investors were just aggressively dumping those high-growth, high-valuation tech stocks, the very ones that have been the darlings of the market all year long.
And of course, the broader market just couldn't escape that contagion. We saw the S&P 500 fall 1.17%, really getting dragged down by the severe weakness we saw in tech and those consumer discretionary stocks.
And even the Dow, which is packed with more of those established blue-chip companies, couldn't stay in the green. It closed down over 0.5%. Now, it definitely held up better than the others, but that negative sentiment was just way too powerful to fight off today.
Okay, so that brings us to the big question. Why tech? Why did tech stocks lead this massive downturn? Let's really dig into the reasons behind all this market panic.
So what triggered the sell-off? Well, you'll see it wasn't just one single thing. It was more like a perfect storm of different factors all hitting at once. And that's what finally seemed to crack investor confidence. So what we're really looking at here is a convergence of pressures. First, you had a specific stock catalyst with Palantir, and we'll get into that in just a second. Then you layer on these broad market warnings coming from some of the biggest names on Wall Street. And all of this is happening against a really shaky macroeconomic backdrop. It was just a potent mix, and it sent a crystal clear signal to investors it's time to take some risk off the table.
So when we talk about valuation concerns, what do we actually mean? Well, at its core, it's the fear that you're paying way too much for a company's future promises. I mean, look at Palantir. It was trading at a price-to-sales ratio of 85. 85! That was the highest in the entire S&P 500. A number like that is a huge red flag for investors because it suggests the stock was priced for absolute perfection, with literally zero room for error.
Okay, so let's zoom in a bit. Let's move from that big macro picture down to the company level. Because, while the tech sector as a whole was bleeding out, the individual stories, well, they tell us even more about what's really driving this market right now.
And this right here is what I'm calling the Palantir Paradox. Think about this. The company completely blew past its earnings estimates. They even raised their full-year outlook. On paper, that is fantastic news, right? But the stock, it plummeted nearly 8%. The market's message was just loud and clear. Hey, your results are good, but your stock is just way too expensive. And that message sent a massive shockwave through the entire AI space. And believe me, the pain was widespread. This wasn't just a Palantir story. You had Micron, a key player in memory chips, down over 7%. Tesla dropped 5%. Even the undisputed king of AI, Nvidia, was down almost 4%. And Meta? That marked its fourth straight day of losses. This shows a really broad-based retreat from some of the market's biggest winners this year.
But amidst all that carnage, there was one major shining exception that completely defied the trend. While pretty much everyone else was panicking about AI valuations, AMD stepped up to the plate. They delivered a report that was a powerful reminder of what strong, fundamental execution actually looks like.
And wow, the numbers really do speak for themselves. AMD beat estimates on both the top and bottom lines. And look at this, an impressive 16% revenue growth year over year. So what's the big takeaway here? It's that even in a super nervous market, real, tangible demand for things like data center and AI hardware can still shine through and get rewarded.
All right, let's pull back out and look at the bigger picture again. Because this one-day sell-off, it didn't just happen in a vacuum. Nope, it happened right as some of the most powerful people on Wall Street were starting to sound the alarm. I mean, listen to this. The CEO of Goldman Sachs, David Solomon, said a 10 to 20% correction in the stock market was likely in the next 12 to 24 months. Look, when the head of Goldman says something like that, the market stops dead in its tracks and listens. This isn't just some abstract forecast. It's a direct warning from the very top, and it signals to all the major funds that maybe it's time to start getting a little more defensive. And this wasn't just a lone voice in the wilderness. The CEO of Morgan Stanley, Ted Pick, he came out and echoed that exact same sentiment. And his framing is really interesting. He said investors should welcome the possibility of a 10 to 15% pullback. That suggests they see it as a healthy, even necessary cleansing of a market that's just become way too speculative.
Okay, so with all of that as context, the big question is, where do we go from here? So let's wrap this up by looking at the key events and data points that you absolutely need to have on your radar, because they're going to dictate the market's next move. All right, you're going to want to keep your eyes locked on these 4 areas. First, inflation data. The upcoming CPI numbers are everything. They will heavily influence what the Fed does next with interest rates. Second, any commentary from Fed officials. Watch for their speeches because a single phrase can move markets. Third, the government shutdown is still going on, and that's creating a data blackout, delaying reports we all rely on. And finally, of course, geopolitical risks. Those are always the wild card. Any one of these could steer the market from here.
And so all of this leaves us with the ultimate question, doesn't it? Was today's sharp decline the first shot in that 10 to 20% correction that Wall Street is warning us about? Or is it just a healthy reset, a much-needed buying opportunity in a market that had clearly gotten a little ahead of itself? That right there is the billion-dollar question that you need to be thinking about for your own portfolio.